Welcome, everyone. We're excited to bring you our latest webinar in our series, Adapting Your Business to Changing Times. We've got two guests with us today, which we're excited to hear more about the topics that we're covering today. First up, we have Mike Crabtree, who's a partner at Boulay, who will be covering the year-end tax updates. And we've also got James Olney, who is a senior employment law counsel at USI Insurance Services, who will be covering the legal developments related to vaccine mandates. So with that, I'll pass it along to Mike Crabtree.
Thanks, Brittany. When we scheduled this webinar, we were hoping that we would have some new tax legislation to talk about, and excuse me, that has not happened yet, but more on that later. So Brittany, if we could jump to the next slide. There are a few things that we should talk about. Like every year, we have some annual adjustments. Some of the numbers that come into your tax return change every year based on inflation, and those numbers have been released now. So you'll see here that the standard deduction is increasing. The 2021 standard deduction on joint return is $25,100, and that's going to go up to $25,900 next year, and half of that amount for a single return. The 401k is going to go up by $1,000 from $19,500 to $20,005, but the IRA limit is not changing. That is staying constant at $6,000, and each of those provisions has a catch-up allowance for people that are 50 and over, and those catch-up amounts are not changing. One thing that is changing, the annual gift exclusion, that is the amount that you can give, amount of value you can give to any one person before you have to file a federal gift tax return. That has been $15,000 for a number of years now, and that's finally going up to $16,000. The Section 179 limit is a big deal for businesses, and that is a provision that allows you to expense the cost of fixed assets instead of capitalizing them and depreciating them over years. That has been started at $1 million. It goes up with inflation. The 2021 number is $1,050,000. And the 2022 number will be $1,080,000. All right. Next slide, Brittany, if we could. One thing that I want to talk about in this kind of unusual, a change for 21 and 22. Business meals and entertainment have always been deductible. The Tax Cuts and Jobs Act at the end of 2017 eliminated the deductibility of entertainment expenses, and there was some uncertainty there for a while on how that related to meals. We finally got that clarified. So business meals have been deductible, but only half, 50% of business meals have been deductible for a long time now. There's a special provision for 2021 and 2022 that allows us to deduct 100% of business meals, provided that they are from a restaurant, which kind of brought up the question of, well, what's a restaurant? And we recently got some guidance on that. What the IRS says is a restaurant means a business that prepares and sells food or beverages at retail for immediate consumption, whether that's on-site or off-site. So it doesn't necessarily have to be like table service at a restaurant where you're talking to a waiter or something. It could just be takeout food or pizza delivery, something that's made to be consumed right away. An exception would be prepackaged food from a grocery store or a convenience store or something like that. So you can't stop at a Holiday and pick up some chuck wagon sandwiches for your business lunch. If you do that, you're only going to be able to deduct 50%. But that is a special provision for 2021 and 2022, and then it's going to go away. We got some clarity that the meal portion of a per diem is deemed to be from a restaurant, so that is 100% deductible. And this is something that Minnesota law does not conform to. So if you are deducting 100% of your business meals, you'll have a Minnesota add back for the 50% that Minnesota doesn't let you deduct. So I do want to talk about the fact that we did not get any major tax legislation yet. That has been on people's minds for a long time, all summer. That the original Biden proposals had a lot of things in them, like changes to tax rates and changes to capital gain rates, changes to the estate tax, just tons of different ideas that were in early versions of the legislation. And as that process has worked its way through Congress, most of those big items have fallen by the wayside. But the House did pass a Build Back Better Act that will be undoubtedly changed significantly by the Senate. But Build Back Better Act, as passed by the House, has a number of provisions in it that are interesting to us. One of the really big ones is what's called the SelfCap, the $10,000 limit on state tax deductions. And this impacts businesses a lot, and we'll get to this pretty soon, but most of our client businesses are pass-through entities, where like S Corps and LLCs, where the business itself doesn't pay the tax, but it flows through to the owners. And so the tax that these owners are paying on this business income is effectively being capped at this $10,000 amount as far as their federal returns go. And we'll talk about a workaround on that. But one of the provisions in the Build Back Better Act is to lift that from 10,000 to the most recent number is 80,000. So that would provide a deduction for a lot of people. This is a pretty controversial provision, though, because there's some pushback on this, because most of the beneficiaries of that change would be higher income people who are paying more state taxes. So, certain senators are pushing back on that. So it'll be hard to know exactly what we'll end up with. And that applies across the board. We don't know at this point what really is going to end up in the final legislation. We were hoping for, like I said before, we were hoping for a final bill by now. We haven't seen it. The latest word, I think, is that it likely won't be done by the end of the year, which means we could very well have a law passed in January of 2022 that tells us what the tax law for 2021 is. We had something similar to that a number of years ago, which just makes year-end planning very, very difficult. A couple other provisions that are in that or have been talked about. One change would be to applying the net investment income tax to active pass-through income. What this is getting at is S corporations have benefited for a long time by having their pass-through income, not subject to the self-employment tax, and also not subject to this net investment income tax if the owner is active in the business. And one of the provisions would be to change that, so it kind of puts S corps more parity with LLCs in that sense, and could definitely end up increasing the tax burden of a lot of pass-through owners. Another provision is a surcharge on very high income earners, which is not going to affect very many people, but there's an additional 5% surcharge on earnings above $10 million. And I think after your earnings exceed 25 million, you get an additional 3% on top of that. So again, not going to impact very many people. The qualified small business stock rules could also change in this. This is kind of a limited thing, but it's a big deal for a lot of business owners. That qualified small business stock, and the provision in the code is section 1202, creates an exclusion for the gain on the sale of qualifying small business stock. It's limited to C corps, but you can make a big deal, and that if you meet the criteria, you can essentially exclude all the gain from selling your business or the stock. And what this change would do would be to revert the rules on 1202 back to what they used to be before 2009, which is a much smaller exclusion, and really reining the benefit on that. There are a couple other things that I didn't put on the slide here. One of them would be the elimination of the backdoor Roth conversion, which is something that some people do if their incomes are too high to make a Roth IRA actual contribution. They make a contribution to a traditional IRA, a non-deductible contribution, and then immediately roll it into a Roth. That whole strategy would be essentially stopped if the language in this current version of the Build Back Better Act comes to pass. But again, none of this is certain, and we'll find out what happens eventually if and when something does pass. Okay, Brittany, if I could jump to the last slide. I've just got one more thing I really want to talk about, which is, oh, there we go. To get back to that SelfCap, a lot of states are enacting these pass-through entity elections, and Minnesota is no different. We got this in July, and what it is, it's a workaround for that SelfCap. And what it does is it lets the pass-through entity, which typically doesn't pay any tax because all the income flows out to the owners, it allows the entity to elect to pay the Minnesota income tax on the Minnesota income from that pass-through entity at the entity level and deduct it federally at the entity level, which kind of, the result of that is that the owners get the benefit of that deduction because their flow through income from a federal perspective is reduced. So they're effectively getting a deduction for the tax on that business income that they wouldn't get typically under the current rules because of that limitation on their deductibility on their own returns. This is a big deal. The IRS just issued a year ago, they issued a notice allowing this kind of thing. Before that, there was a big open question of whether or not the IRS would allow this to work. And they gave the green light about a year ago. And since then, I think about 21 states have adopted these kind of things. And it's for certain businesses, certain taxpayers, this can make a really big difference. If there's a lot of income flowing through your pass-through entity, the Minnesota tax on that can be significant. It's a little complicated, and definitely talk to your CPA about it. But one of the provisions in the federal notice that allowed for this really makes it sound like this is on a cash basis. So to get the benefit in 2021, you would want to make that payment to the state by the end of 2021. So it's time's a wasting, as the expression goes. So, but those are the big things I really wanted to hit. Again, we are going to, if you have questions, put them in the Q&A box, and then we'll collect all those at the end and provide answers to everybody in attendance. So thanks for your time. I'm going to shift it over to James Olney now. So, all right. Yeah. Welcome, James.
Thanks, Mike. So a couple things by way of introduction. This is one of those situations which hurry up and wait is actually a fairly apropos expression when it comes to things like the various vaccine mandates that have been issued by the federal government of late. If we can go to the next slide, I'll do a quick high-level overview of the various types of mandates that are out there. We're going to talk primarily about the OSHA ETS. ETS is shorthand for Emergency Temporary Standard, for those that didn't know that. But that's not the only thing that exists out there. There are, in fact, several different mandates that all came to be right around the same time. So even if you're not covered by one of them, you may in fact be covered by one of the other ones. And so let's do a quick sort of snapshot of the ones that are out there, starting with the OSHA Vaccine ETS. That was published to the Federal Register back on November 5th of 2021. And within very short order, meaning exactly one day, about 24 hours or so, a court out of the Fifth Circuit Court of Appeals issued a stay, which at least put it on hold for that particular limited set of states. We'll talk about more about the current status of the ETS in a second. But the ETS, I think, contrary a little bit to what you're seeing in the press, actually is a mandatory vaccination requirement. It allows for an optional add-on opportunity for employers to also include testing and mask wearing as an alternative to vaccination. But as an employer, you don't have to do that. You can make the choice, in fact, to just go all in on the vaccines. We'll talk a little bit more about that in a couple of slides. So that's the essence of what the ETS was. In turn, the ETS had two effective compliance dates. The first of those was December 5th of 2021, where about 90% of your compliance stuff was supposed to have been done by that point. You're supposed to have a record of people's vaccination status. You're supposed to be requiring vaccinations, supposed to be providing some paid time off for it, all that sort of stuff. And then there was a secondary date of January 4th, which was going to be for the actual testing piece of it to go into place. OSHA felt that employers would need a little bit of extra time to get that to actually come into being. Now, I've got an asterisk by that, and you'll see why when we get to the next slide. So put that on hold. Let's talk about the second of these two bubbles here, which is the federal contractor mandate. Now, the federal contractor mandate is something that applies to people who are direct contractors with the federal government or second tier, downstream, or indirect contractors with the federal government as well. For instance, let's say that you provide some service that somebody in turn utilizes on the part they make for a jet engine that ultimately Boeing sells to the government. Even though you're 2 or 3 or 4 steps removed from the federal government direct dollars, those services you provide may in fact make you a federal contractor. If so, you may have to comply with the federal contractor mandate. The reason that's important is because, like I said with the ETS, it's a mandatory vaccination approach, but it has that alternative for testing and masking. The federal contractor mandate doesn't do that. It's all in on vaccines. And it's very, very rigorous. So basically, anyone who works directly or indirectly on federal contracts or at a location where such work is performed would have to be vaccinated. And the only time there might be an exception to that is if somebody was medically incapable of being vaccinated or had a sincerely held religious belief that opposed it, in which case then maybe testing and masks might be an appropriate alternative. The compliance date for the federal contractor mandate, there are actually a number of different moving parts to it, but the primary one was supposed to be January 18th of 2022, so coming up here in about a month or so. That is asterisked. You'll see why in the next couple of slides. But ultimately, for those of you that know that you're a federal contractor in one form or another, if all you are is a products contractor, meaning all you do is provide products for those types of contracts you work on, the federal contractor mandate wouldn't apply to you, but the OSHA ETS one, a vaccine ETS one might. So let's then shift to the third column here, the CMS mandate. CMS is short for the Centers for Medicare and Medicaid Services. Ultimately, if you're a healthcare provider, that also includes nursing homes and things along those lines, that are recipients of Medicare or Medicaid funds, you may be covered by the CMS mandate. Much like the federal contractor mandate, it's all in on vaccinations. There is not an alternative to do the testing and masking option. That was supposed to go into full effect by January 4th of 2022. It's asterisk. You can already probably guess why, but we'll get there in a second. And then the last thing, and this hasn't gotten much press. So there have been legal challenges to these first three, a flurry of them, not surprisingly. But OSHA, somewhat quietly, but without any objection or opposition, actually issued an ETS, an emergency temporary standard, specific to healthcare providers back in July of 2021. July 21st to be more specific. And basically, it wasn't a vaccination mandate per se. It strongly encouraged such things, but it was saying to those healthcare providers, for those employees that are covered by this particular healthcare ETS, these are the safety protocols, cleansing protocols, masking protocols, respirator protocols that you guys need to follow. So that's in place too. That becomes relevant in a few slides. So if we can go to the next slide, let's find out why all these asterisks actually exist. Starting with the OSHA Vaccine Emergency Temporary Standard. Like I mentioned, the Fifth Circuit Court of Appeals very promptly issued a stay that was limited probably only to Texas, Louisiana, and Mississippi. However, on November 12th, the Fifth Circuit expanded that stay to actually cover the entire country. Now, OSHA disagrees with the stay and the legal premise that underpins it, but on its website on or about the 12th of November, OSHA did say that they were, quote, suspending their activities related to the implementation and enforcement of the ETS, end quote. In other words, they were saying, we agree for now to comply with the stay that the Fifth Circuit has issued. That doesn't mean they agree with it, and they are legally challenging it. For reasons that are more arcane than we need to go through for today's presentation, the Sixth Circuit Court of Appeals is the Circuit Court of Appeals that has been assigned to adjudicate all of the challenges across the country that the ETS is facing. So all of them are being aggregated into one monster case. The deadlines that you see here, November 30th, December 7th, and December 10th, are somewhat speak for themselves the way that I've written them. But the key thing to take away from this is, so OSHA moved the Sixth Circuit once the Sixth Circuit was assigned to take all this on. OSHA said, hey, Sixth Circuit, would you remove the stay that the Fifth had put in place? We want to move forward with the ETS. We need you to remove the stay. The Sixth Circuit said, no, but we're going to brief this issue. We're going to let other parties join. We will issue our opinion here after we get all the briefing done, which the last of which was due on December 10th. For those who are paying close heed to the previous slide, remember I said that December 5th was the first compliance date for the OSHA ETS. Well, that's in our rear view mirror today. Today is the 16th, but it was also in the rear view mirror on the 10th when the final briefing was going to be due. The Sixth Circuit has not issued its opinion on this yet. In other words, the ETS is certainly not going to go into effect on the dates that it was originally pegged to do so. If OSHA is successful with its legal challenges, they will probably issue some new dates for compliance, but certainly the ones that previously existed are no longer going to be applicable. Okay, if we can go to the next slide. So in addition to that, so there were a bunch of legal challenges to the OSHA ETS. There were also legal challenges to the CMS mandate and the federal contractor mandate that I mentioned on that first slide as well. No surprises there. On November 30th, a Louisiana Federal District Court issued a nationwide preliminary injunction against the CMS mandate, so that too is on hold. Similarly, on December 7th, a Georgia Federal District Court issued a nationwide injunction against the federal contractor mandate. All of these things are being appealed, so nothing is final until it is final. Frankly, most of these things are likely to get up to the Supreme Court, I would imagine. But so there is some legal road ahead of us, and I'll give you some suggestions about what to do with all those conundrums here in just a minute. The one thing I will point out, in case you care about my prognostications on this, I think that the ETS faces a somewhat difficult legal course ahead of it. It doesn't mean it can't be successfully pushed through, but at least it has some pretty strong headwinds. The CMS mandates and the federal contractor mandates might have less headwinds against them because the OSHA ETS is a direction employers must do X, whereas the CMS mandate and federal contractor mandates are saying as a condition of receiving money from the government, employers must do X. And so there may be some greater latitude there, but prognostications aren't worth anything. I wouldn't place a lot of bets in Vegas based on what I just said. I'm just pointing that out. Next slide, if we could. So in addition to that, and Minnesota is not one of these, but a slew of states in response particularly to the ETS put together legislation that was supposed to countermand or overrule the OSHA ETS and then the subsequent contractor and CMS mandates as well. So these various pieces of legislation, while they all say slightly different things, essentially say you can't require proof of vaccination, you can't require mandatory vaccinations, you can't require frequent testing, all that sort of jazz. I will point out that in the hundreds and hundreds of pages of the OSHA standard that was put out as part of the ETS, there was a very lengthy disquisition within it where OSHA said, this is why we believe we have the legal right to do this. And we also believe we have what we call federal preemption. In other words, hey, all you states that are putting these laws into place, tough beans, doesn't matter. We think we can overrule them through this legal concept called federal preemption, and that none of those state laws are going to apply. For us in Minnesota, none of it matters because Minnesota hasn't taken an oppositional legal point of view. Next slide, please. So who is covered? Who is it that has to worry about it? The one thing that, assuming the ETS makes it through it, the legal challenges is certainly known, is that private sector employers with 100 or more employees are going to be covered. Now, that's superficially simple. The devil's in the details. What does it mean to have 100 employees? For those of you that have multiple locations or multiple corporate entities, let's start talking about the multiple locations first. It's all your entities, all your locations together, not just a single location by location assessment. Is do you have 100 or more employees on the payroll or not? And that includes part-time, that includes seasonal, that includes temporary employees hired directly by you. If you have an employee coming from a staffing agency that's on the staffing agency's payroll, they don't count towards that head count. A lot of our clients have said, well, what about multiple corporate entities that have different, EIN numbers? The more shared services those corporate entities have, if they share payroll, if they share health insurance, if they share safety practices, the more likely it is that OSHA is going to aggregate them, but there isn't a hard and fast formula that OSHA applies. Private sector employers with fewer than 100 employees are not going to be covered unless at some point they go over the 100 threshold while the ETS is in effect, in which case they will be covered for the duration of the ETS, even if they drop again below 100. And states that have their own state-approved OSHA programs, and Minnesota is one of them, could conceivably drop those thresholds below 100 employees too. I've not seen any indication that Minnesota will do that, but it is conceivable. Next slide, please. So here are the requirements and the penalties. First off, it requires that employees be fully vaccinated. To be fully vaccinated, that is, and OSHA ETS defines this, 2 weeks after the completion of your vaccination series. So that's after your second dose of the Pfizer or the Moderna, or after your first dose of Johnson & Johnson. Interestingly enough, booster shots, at least as we speak today, are not included in the definition of full vaccination status for ETS purposes. You have to, if you're covered by this, maintain proof of individual vaccination status on each individual employee in your organization. You also have to have a master list that identifies out of our 150 employees, 110 are vaccinated, 40 are not. That list must be provided to anyone who asks for it, employees or employee representatives. You also have to provide 4 hours of paid time off for people to get each dose of vaccination to complete their initial vaccination series. That 4 hours must come from your general operating assets. It cannot come from PTO or sick or vacation balances I may have. It comes from you. You also must give me time off with pay to recover from the side effects of getting vaccinated, should I actually suffer those. Now, you can make me use my sick or my PTO time for that, but if I don't have enough to cover my absence or I don't have any, that you're going to have to pay for without making me go negative. And then last, and certainly not least, OSHA means business on this. And they mean business because they will assess very significant penalties, $13,650 as you can see here, or $136,000 and above for repeated and willful violations. The way that OSHA comes in, they can come in on a random inspection, which is pretty unlikely, or if somebody picks up the phone and goes online and complains, one of your employees who's disgruntled for whatever reasons, that's usually a very big trigger for OSHA to come in. So it is actually plausible that they could do so. Next slide, please. Very quickly here, since I don't have a ton of time, these are the situations under which the testing alternative can be applied. If I regularly come into the office, even if it's just once a week, each week I come in, I need to provide proof of a negative test result. And I certainly have to mask anytime, as I'll explain in the next slide, that I may be in the presence of others. If I'm not coming in regularly, so I work from home primarily, but I come in once a quarter for a quarterly meeting, I'm going to have to provide proof of negative test within 7 days prior to my coming in. If I can't provide you a negative test result, I can't come into a workplace where those are present, period, full stop. If I'm working manufacturing, which means I can't do it from home, I'm going to have to sit at home without pay until I can provide proof of a negative COVID test. And then finally, if I do actually have a positive test, at that point, I'm not going to be subject to the weekly testing requirements for the 90 days after I was diagnosed because of the risk of false positives. So even though normally I'd have to provide weekly test results, I get a 90-day reprieve if I actually have a positive test result. Next slide, please. And the second to last but not least, here's the folks that, here's how masking works. I need to be masked unless I'm alone in a room that has floor-to-ceiling walls and a closed door, which my office has right now. So if I weren't vaccinated, I wouldn't have to wear a mask. If I'm eating or drinking in your break room, I can take off my mask specifically to do so. Or if I have to remove it for ID purposes, for security when I come into the building, I can do it briefly then too. And if I'm wearing a respirator as part of my job anyway, a respirator is actually more is better and more protective than a cloth mask. I don't need to wear a cloth mask beneath that respirator. So those are basically the scenarios under which I would have to be masked. Next slide, please. Which gets us to our key takeaways. As it turns out, 15 minutes is a very, very fast sprint to run when there's a whole lot of stuff to talk about. So let me do my summation here. What are you going to do with all this? You know, again, all this stuff is on hold. And so given that, does that mean you don't have to worry about it? And the answer is no. There are three options that you have. Number one, take the no worries approach. Until the courts tell you you must do something, just ignore it and pretend it's not there. And that certainly is a plausible approach today, because until these things pass successful challenge or successfully pass legal challenge, they're not in effect. The second approach is to go the opposite extreme of that and say, well, whether or not they succeed with legal challenge, we're going to take a formal position on vaccines or tests, and we're just going to move forward on our own initiative, quite apart from these various mandates. Perfectly legal, perfectly valid, put that on hold. Your third option is, if one of these mandates applies to you, continue the process of preparing to comply, but don't implement it yet. So put together a policy, have your practices in place so that should they successfully get past the legal challenge, you'll be ready to act on it quickly as opposed to having to play some catch up. So on that pause point, if you decide to move forward with your own vaccination and or testing requirements, most of those independently determined employer initiatives have passed legal challenge, as opposed to these mandates, which are broad and obligations for employers as a whole. So if you want to do it, you probably can. No matter what you choose to do, at least do so consciously and knowingly. It's important to make a decision in these areas and know why you have done so. So at least that way you can stand by it and support it and revisit it if in fact it turns out that you need to do so. The last thing I'll say here before I call a close to the day, it's important to make sure as you make these decisions that you work with trusted advisors, people that can give you guidance that's going to be useful to you, your culture, your environment, et cetera. It is something that you want to have support where you possibly can so that you don't have to do it alone. All right, I've exceeded my time by a minute. Thank you a ton for listening and for paying attention. I appreciate the invite and I hope you found this useful today.
Thank you, James. Just as a reminder to our participants, we are recording the webinar and we'll send that out post-webinar. But if you do have any other questions that come up, please feel free to email us at learnmore@boulaygroup.com and we'll work with James and his team to get those answered if you've got any questions either on tax or on vaccine mandates. With that, thank you all for attending.
Thanks, everyone.